So the best way to describe Bitcoin, people have described it using a very fancy term called a decentralized ledger, which is what the blockchain is. But I'm going to put it in very simple terms. So if you have a bank account, let's say you have a checking account with Wells Fargo, they are very careful to monitor how much money goes into the account versus how much goes out of the account. And the reason for this is that you should not be able to spend money that you don't have. You should not be able to double spend the same dollar twice. And this is the same thing that the Bitcoin blockchain tries to accomplish. The Bitcoin blockchain, as it sounds like, it's just a chain of blocks. It's a chain of blocks that are all strung together, and each block contains a whole bunch of transactions. I'm going to show you a picture of it in a minute. But basically, one block contains the record of all the transactions that have taken place for that block. These are people who are buying and selling Bitcoin, sending it to another address. And this blockchain goes all the way back to 2009 from when Bitcoin was created. It's a record of all the transactions that have taken place since 2009. We can go to what's called a blockchain explorer or block explorer. And we can see here, I'll link to this in the description notes below, you have something called height, which is really just, I guess if we think of it, this is the height, all these blocks stacked on top of each other. And we're currently, as I'm recording this, we're on block 641,172. That's how many blocks have been created and added to the blockchain since 2009. Now, if we just click on this top block, block number 641,172, I'm just going to open it in a new tab. We can see the number of transactions in it. There are about 3,231 transactions. You can see a whole bunch of other stuff that I'm not going to go into right here. But if we scroll all the way down, we can see the individual transactions that are included in this block. So here, for example, someone sent 31.0569 Bitcoin. And this goes on and on for, call it 10 pages. So this would be a single block like this new block right here that's being added to the blockchain as we speak. Now, the great thing about the blockchain is as you get very far down here, these old blocks cannot be changed or modified because of the way the code works, so they're extremely secure. So we've talked about these new blocks being created every 10 minutes. Who exactly creates the new blocks? Well, you may have heard of Bitcoin mining or Bitcoin miners. These are people who run these very specialized computers, and they are the ones who create these new blocks. And they're called miners in the sense that whenever they create a new block, if they win the race, basically they have to solve a complex math problem, a cryptographic puzzle, using the computer. And if they win that race, they get to create the new block, and they get paid a reward in Bitcoin for being the first to do that. Right now, that reward is 6.25 Bitcoin for one block. Again, these Bitcoin miners, they're not digging in the ground or anything. They're very specialized computers, and used to be able to do this on your computer now, but there's been kind of an arms race in computer power, so you need very specialized machines to do now. Here's an example actually from Etsy of a sort of boutique Bitcoin miner. You can use these to mine different cryptocurrencies. Bitcoin's the only one I like and I'm interested in. This just gives you an idea of what they look like. Normally, you'll see these giant Bitcoin mining rigs or farms where you see many computers strung together. And these things are expensive. People have a lot of faith in the future of Bitcoin, especially Bitcoin miners, and they're willing to actually spend billions of dollars on mining equipment. And the key for Bitcoin miners is they just want to earn enough, they want to earn more from mining new Bitcoin than it costs them to set up these buildings with these specialized computers in them, to pay for all the utilities, to pay for the electricity, to pay for the cooling, etc. So we've talked about the blockchain, just a string of blocks. We've talked about the miners who create the new blocks. Now we're going to talk about the nodes. A node, especially a full node, is just a computer that's running the Bitcoin software, and that contains a complete copy of that entire blockchain. That's why it's called a full node, because it has the whole blockchain on there. Now you can run a partial mode, but it's most helpful to the network if you run a full node. This does require a fast internet connection and a good data plan, because it can be expensive. and the blockchain itself now is about 329, 330 gigabytes, getting bigger every day. And so if you run a full node, and you could basically do this on your laptop or desktop, especially if you have a free one that you're not going to be using for anything else, you basically just go to the Bitcoin website, and I'll link to this. This explains how to run a full node, all the different, whether you're running Windows or Linux or Mac operating system. And you can just go here, you download Bitcoin Core, and it will basically start communicating with other computers on the network, on the Bitcoin network, other nodes. Now, the nice thing about this software is that it constantly is checking out the blockchain and new transactions and making sure that there's no fraud, that there's no double spend, etc. And so the more nodes in the network, the more secure the network is, and the more real power is in the network. I'm going to show you a map right now. These are all the nodes around the world. When people talk about government shutting down Bitcoin, especially the United States shutting down Bitcoin, which it's certainly not going to do. It looks now like they're going to regulate it. But you can see there are all these nodes in North America, in Europe, in Russia as well, in China, in other parts of Asia, in India, in Australia, in South America, etc., in Africa. And so even if the U.S. government decided to shut down, to somehow go into people's houses and turn off all these nodes, again, this is a very decentralized network. It's spread all around the world. Just because the U.S. decided to maybe treat Bitcoin like marijuana and break into your house and make sure you don't have either of them, they wouldn't be able to do this to machines in China or Russia. They're not really going to put up with it, etc. So this is the real power of the Bitcoin network. It's completely decentralized. It's not controlled by anyone. It's basically all of these nodes talking to each other. They make sure that nothing is fishy. They verify all the transactions, and they make sure that the same address to the same person is not spending the same Bitcoin twice. All these Bitcoin nodes talk to each other. They all download the blockchain, and they all continually update the blockchain, and then they compare it amongst themselves to make sure that this decentralized ledger, just like you would have a ledger for your bank account, a list of all the money coming in and all the money coming out. In the case of Bitcoin, this is shared all around the world on the Bitcoin network by all these different nodes. And we say it's decentralized because it really is this peer-to-peer network. There are all these nodes around the world running the Bitcoin software and talking to each other. And this is one reason that it's very difficult to come up with your own cryptocurrency or reinvent Bitcoin, maybe do a hard fork, as people have tried to do with some of the Bitcoin forks, is that you can do whatever you want. The Bitcoin software is open source. You can change it. But how do you convince all these people around the world to run your software? This is the real power of network effects, the power of having so many people invested in the Bitcoin network, both by running full nodes, as well as all these miners who have spent millions or even billions of dollars investing in Bitcoin mining.
Proof of work is very important because it is the first workable, in my opinion, solution to the double spending problem at scale. As we know, a lot of different alternative currencies and alternative money forms were created in the 90s, in the early zeros. Unfortunately, though, they didn't work quite well because most of them were centralized, more often than not, of course. And when something is centralized, it is very easy to shut down. A privilege of creating and controlling your own money, let alone a monopoly on it, is something that gives sort of the controllers of that system a tremendous amount of power, arguably more than anything else in the world. With Bitcoin, proof of work, once again, coupled with several other things, allows the system to be secure and decentralized at scale, as well as allows us to timestamp transactions on the ledger in a sort of decentralized, trustless, or rather trust minimized manner, which allows Bitcoin for the first time to be an alternative monetary system and an alternative currency, which is several orders of magnitude much harder to shut down, to censor, to stop, and to manipulate than any other project of a similar variety that has ever arrived in the past.
So just maybe walk us through how you see the Bitcoin network as like a defense mechanism.
You know, you can abstract governments as effectively a trade mediation as a service, right? This is like, it gets back to like the champagne fairs in medieval Europe. You would need a military. You need a military to preserve trade routes, right? That's why you have Navy. Okay, the Navy will make sure that we don't, that our trade routes are uninterrupted. You need a rule of law, right, to preserve the rules of the contracts, to build the contracts, to preserve the rules of the contracts. And then you need a monetary entity as well. Bitcoin is all three. It is a military, it is a rule of law, and it is money. The miners, the mining network is its military. The nodes, right, and the software is the rule of law and the legislation and all the voting. And the least interesting part of it, in my opinion, is the money, the Satoshis, right? That's like the thing that comes last. What makes Bitcoin so special is that it has its own military that is literally as powerful as nation state militaries. All civilization, all living creatures obey the social consensus protocol that those who project the most kinetic power in the most clever way earn the right to set the state and chain of custody of limited resources. No one gets the option to like unsubscribe from this social consensus protocol, right? Those who project the most kinetic power set the state and chain of custody. The role of the military is to project so much kinetic power that it's too expensive not to cooperate with whoever owns that military, right? That's the main deal. Animals will actually grow random power projection mechanisms out of their foreheads so that they can continue to play the game and establish pecking order and to achieve consensus on the legitimate state and chain of custody of resources like territory, right? We call them antlers, right? We call them, look at bugs with their weird horns on the top, right? The cool thing about kinetic power projection is it's a permissionless protocol. I don't need the permission of another country or another person if I can project enough power in a clever way. Bitcoin takes the exact same game, right? But it transposes that game digitally. So instead of kinetic proof of work, you do electric proof of work. So let's just do a thought experiment.
I would love to do a thought experiment with you. Go ahead.
How many bombs would it take to blow up the internet?
A lot.
Yeah.
I don't know. Maybe you've thought about it. How many?
It would probably take a lot of bombs, right? Like to stop Bitcoin, you would have to hunt down every miner forever, right? And maintain that. And so that's like really difficult to do. The thing that bothers me about like these ESG accusations against Bitcoin is like they fundamentally misunderstand what the point of Bitcoin is, right? They fundamentally misunderstand what the point of all that energy or all that power projection is. The point of projecting that much power is to make it too expensive to attack the ledger, right? Like to make it too expensive to be uncooperative with the people who use Bitcoin. This is exactly what the military does, right? The power of every single bomb, the power of every single bullet, the power of every heartbeat of every service member of every military in the world is measured in watts. And those watts are spent explicitly to protect and defend resources. And to say that Bitcoin is a waste of energy is effectively the same as saying your military is a waste of energy. It's a waste of energy to have a standing military to protect our rule of law or whatever we're trying to protect. Like, yeah, it's inefficient to sail a bunch of carrier battle groups through the ocean, right? You know, it's more inefficient, Anthony, than sailing a bunch of carrier battle groups or testing about a bunch of nuclear missiles all the time. Being invaded, being conquered. The point of Bitcoin is to defend the network, to defend every user that volunteers to make that underlying piece of property their form of money.
Today, Bitcoin is 21 million total supply, right? That is what is written into the code. Detractors would argue that that can change through two different ways. One is if the miners all agreed to allow an increase in the total supply.
To answer your first question, miners aren't in control of Bitcoin.
Okay.
Full nodes, i.e. users, are in control of Bitcoin, and the user activated soft fork is something that has essentially proved that. More than 93% of miners wanted to increase the block size in sort of their way. More than 85% of the companies, exchanges, wallet providers were on their side as well. Essentially, many of the wealthiest Bitcoiners were on their side. However, so the users and those people running full nodes, they decide what kind of code to run, and as well as what kind of transactions to approve. Miners cannot make these changes to the code without consensus. And at the end of the day, Bitcoin is this impenetrable fortress of full nodes, which really collectively, as we've previously discussed, in a P2P network fashion, control the network. And I strongly recommend Stop and Decrypt's article titled "Bitcoin is an Impenetrable Fortress" for more nuance on this topic.
What is so special about the governance of this digital currency?
So, governance of Bitcoin is not formally defined, and I would argue that in a way it is a strength rather than a weakness. Technically, the governance has to do a lot sort of with the Bitcoin improvement processes and how those get proposed and how those get reviewed, how those get added in, etc. It's a very conservative, extremely meticulous process, which I consider a strength. A lot of people consider that, or a lot of people complain that Bitcoin is not evolving or Bitcoin is too slow. And to me, those people are sort of exhibiting high time preference and impatience. I think the altcoin boom and the ICO boom, a lot of the blockchain boom as well, has its origins in part because of this. True Bitcoiners understand that this isn't a 6-year get-rich-quick scheme, but it can be an 80-year project. And it's something that perhaps will continue going on until the end of our lives. And so every changes to the system need to be extremely careful. I like to compare it to like a nuclear reactor or a heart surgery or like a moon mission, because there's a lot at stake. More than $100 billion already, and potentially tens of trillions of dollars someday, right? And so this, because it is software, it lends itself to flexibility. This malleability has allowed us to create a money that is harder and sounder than gold and fiat, of course. But at the same time, this malleability is also makes it fragile in a number of other ways. And sort of because of this, and precisely because it is software, we need to be extremely careful. But the governance process of Bitcoin is what Pierre Rochard calls a P2P anarchic network governance. And the fact that it is slow to change is something that really makes Bitcoin far stronger than everything else. And the number one reason, and I can give dozens of reasons, but the number one reason why altcoins are far behind Bitcoin is precisely because they are much more centralized in relative terms, and everything about it is much easier to change. And currencies, first and foremost, are all about trust. As I like to repeatedly say, these crypto assets are, unlike many people sort of in the VC world, San Francisco, California, they think of these things as software platforms. They try to apply the late zeros, early 10 sort of tech paradigms to this thing. But really, to me, it's a monetary phenomenon. In very loose terms, I like to describe these things as digital monetary metals. To me, that's sort of arguably the closest metaphor for now. I like to even say that they aren't, Bitcoin being compared to digital gold is an understatement. And really what it is digital monetary nuclear weapons. Because if you really dig into the third and the fourth order game theoretic effects that are likely to arise when this thing gets just a little bit bigger, which to me it inevitably will, there is just so much that it is going to cause and reorganize in this world. Uncensorability is cool. Unseizability is cool as well. But to me, these really are perks. In terms of like the price going up and this thing taking over the world, if we create a pie chart, the 90%, i.e. the dominant force, which will be doing that, is Bitcoin's monetary policy. And really, it's unprintability. The fact that nobody can print beyond 21 million. That is by far the strongest and the most important innovation really here. People need to use something as money.
Yep.
Right now, some of the better currencies are the US dollar, euro, the Swiss franc, etc. But really, people use those because essentially they're picking the least bad thing. I believe the supply of the US dollar in the last year has increased by 6.2%. Bitcoin's stock to flow ratio today is around 3.8%. And after the next halving, if you go off of the 21 million number, it's going to be 1.7%. Unlike other currencies, which their respective central banks, in the case of fiat, can print essentially whenever they want, and as well as their sort of respective local commercial banks can create more of when issuing debt, Bitcoin is limited to strictly 21 million units. Some of them, it is believed that several million have already been lost. I believe that when all is said and done, the global supply of Bitcoin is going to be somewhere between 16 and 17 million. The fact that nobody can print beyond the 21 million limit, and the fact that the users, the miners, and essentially everybody in the developers, everybody who has as little as one Satoshi of Bitcoin, they are incentivized in having that rule be the number one and the most important sort of rule, and the number one focal point, the number one selling point, which the community is gathered around. And really, this is the number one thing which allows Bitcoin to continuously increase in value. And people are already pricing in its extreme scarcity. I like to say we've never had an object, let alone a money, as scarce as Bitcoin before. Even gold is expanding at a rate of around 1.6% per year over the last 10 years. Now, I believe that by the late 2020s, that number for Bitcoin is going to be lower than 1%. And it is every year it's getting lower and lower. So technically, that number is getting lower every 10 minutes. And as you might know, every 4 years, there's a particularly additional sharp drop as well. And so I believe that soundness, that hardness of currency isn't palpably felt by people yet. And even a lot of participants in the market, a lot of sort of traders and investors, they don't really quite grasp this aspect yet. But I believe that this is the revolutionary thing here. And this is why I believe Bitcoin is going to be in the hundreds of trillions in today's terms in the future. And sort of this is my reasoning around this. Right now, it is believed that the total money supply of all fiat currencies around the world is somewhere around $80 trillion. Um, if you consider M1, M2, M3, if you add them all up around the world. And I strongly believe that that number is artificially diluted and artificially kept small, because essentially by continuously printing, governments are disincentivizing the world and disincentivizing investors and even average people to store too much money in currencies. Because the current fiat currencies are inflationary, a lot of high net worth individuals and asset managers around the world use the stock market, use the fixed income markets, use the real estate markets as a store of value. That is part of the reason why if you try to buy an apartment in Tokyo, London, or New York, the prices are insane. And this is because both American high net worth individuals and foreign high net worth individuals use these sort of prime city luxury apartments as one of their stores of value. And I believe that sort of because the fiat currencies are constantly diluted, at the same time, this has caused an artificial sort of increase in the value of other asset classes and other financial instruments as people are hunting for yield. People like surgeons, artisans, dentists, etc., engineers, they either have to play part-time investors on the side, or they have to sort of outsource those services to registered investment advisors and brokers, etc. And that's part of the reason why the financial system is much bigger than it has to be, and why Wall Street is just a ginormous part of the world's economy. If we had something like gold, or better yet, Bitcoin, then you could save your wealth and it would actually gain a little bit of purchasing power every year without having to sort of have this anxiety-riddled wave of activities that you need to do. And it's actually quite crazy how in today, I'm not even talking about the second or third world where this isn't even an option. Even in the first developed civilized Western world, you have to create a diversified portfolio of equities, bonds, small caps, munis, commodities, FX, derivatives sometimes, etc., just to preserve your wealth. I'm not even talking about making some tremendous outsized returns. I'm talking about just to save your wealth. And this is crazy. And like in biblical times, there's a famous Jewish proverb which says, keep a third of your wealth in money, which was gold, keep a third of your wealth in land, and keep a third of your wealth in your business. And even as recently as in the 50s and 60s, you could notice that in portfolio allocations, some of sort of the traditional mutual funds and the early big asset allocators, they had a much bigger allocation to cash when sort of the trust in currency was much greater. And you saw that reduced as years went by, and in recent decades with quantitative easing, essentially the trust in currencies gets incrementally reduced.
We had 500, 600 million in cash, and we were buying our stock back a bit. And then we were thinking maybe we'll need to buy another company. We need it for a rainy day, or maybe something really bad will happen and we'll really need the money. And it wasn't that long ago that the risk-free interest rate was 5% before the great financial crisis. And I'm like, well, I'm going to make $25, $30 million a year on this. And I kept hoping and waiting for those good times to come back. I was the guy that when the interest rates, when the 30-year T-bill interest rates started to go to 3.5%, I'm like, finally, they're going to go to 4, and then they're going to go to 5, and they're going to go back to normal, right? Normal interest rates. And then, of course, hope was dashed. It went the other way. I didn't really think about it until I got slugged in the face with the 2x4, which kind of happened around March or April, when Main Street shut down, the economy shut down, and bonds went through the roof. When municipal bonds went up while every city is bankrupt, when Apple stock and every other public tech equity went up, and the multiples blew out, and the economy went to the worst place I've seen in 30 years, at that point you start having a thought with yourself, which is, what is the true inflation rate? And now, what does that mean to me metaphorically? Well, here's how I feel. I felt like I had $500 million of cash in the bank, safe, and it was yielding 2-3%, and I'm ready for a rainy day, and then I'm starting to do stuff with it. And then every month, some banker sends me a note saying the interest went down, it went down. Now there is no interest. And then someone took my cash out of the bank and they put it in the backyard in pallets. And then they opened my back gate. And then every month someone comes along and starts burning 2% of the money. And then I started thinking, well, in 12 months, 25% of the money is going to be gone. And then I started thinking, what is the point of all this? What am I doing wrong? And of course, the answer is you can't hold cash. And so what do you do with it, right? There's 3,500 publicly traded companies. There's $5 trillion in their treasuries, and it's all melting. And and yeah, at some point you have a fiduciary obligation to not lose the money. Okay, like it used to be acceptable to be conservative, but that was before the asset inflation rate went from 6% to 30%. When the inflation rate goes to 30%, it's not necessarily something you can ignore.
People monetize investments as money for lack of good money. And so, in this environment where, their bank accounts yielding zero, official CPI is running at 7%, even before this disinflationary period, I mean, even over the past decade that was disinflationary, if you look at real T-bill rates or real bank cash rates, they were below zero for the vast majority of the past decade. It was mildly below zero, but it was below zero. And so because that money situation's been so weak, there's been a natural tendency to just stuff as much capital as you can into equity markets in particular. Also second homes and trophy assets and things like that. But for a lot of people, it's equity markets. And even for a lot of foreign investors, it's U.S. growth equity markets. And so if you look at valuations over time, so much capital has been shoved into them that now you can have much lower forward expected returns, even from good companies, just because their multiples are so high. In addition, if you have, it's one of those things where if equity valuations are reasonable, people should obviously pile into those rather than treasuries. But at a certain valuation level, if you're concerned about, say, broad indices not doing very well over a 5-year stretch, then their risk reward can look as bad as bonds in some cases.
Digital gold is a great narrative, but to say that this is much better than gold undersells it. Because the truth is, if you look at these treasuries, there's something like $200 trillion worth of debt instruments and other treasury instruments that have a negative real yield. And precious metal is just one of them. So if you're looking at $10 trillion in gold, there's easily $100 trillion of, what is this, shadow money, 75 trillion of that, 75 trillion of sovereign debt, 50 trillion of other stuff. So you're really looking at 200 trillion or more of negative real yield. The only debate is how negative it is. And Bitcoin is the only thing I could find that's positive.
This is the 5-year moving average of Euro area government debt to GDP combined. It's flat. In fact, it's going down into the crisis. So where's the orgy of overspending? Interestingly, it comes around here in 2008. What happened in 2008? Do you remember anything? Might be like a giant global financial crisis where the entire global financial system got bailed at the taxpayer's expense. That might have something to do with a large increase in debt. Now, there was one part of the story that you never hear about, which was what meant to happen next. Because how do you get out of a debt crisis when you've generated a huge amount of debt? Whoops. And that is a huge amount of debt. Well, what you're meant to do is something called financial repression. And how do you do that? It's a weird term, but basically what it means is you're going to inflate your debt away. So how are you going to do this? Well, you got all your local bonds and local banks, and then you basically drop what's called the coupon payment, and you lengthen the maturities out to infinity, and then you run a positive inflation, and basically inflation eats away the value of the debt. This is what we did after World War II in this country. Within 10 years, a third of our debt after World War II was gone. Nobody even noticed. It's defaulting by inflation.
Over the past 200 years, 51 out of 52 countries that got over 130% sovereign debt to GDP, in some way or another, did not pay that back in purchasing power terms. So either they default, which is common in countries where it's denominated in a currency that they can't print, like Argentina with dollar-based debts, or they restructure it, which is another. It's like a more polite default, or they pay it back, but it's inflated, right? So they have a higher rate of inflation than their interest rates for several years. Some cases hyperinflation, but more commonly just some degree of inflation. And a really good example is, so United States history, we've only had one period in history where we had federal debt to GDP as high as it is now, and that was in the 1940s to fight World War II. And the way that they paid for it, of course, you had a tax increases on people, but in addition, I mean, they issued a ton of treasuries to pay for that, and just because it was an overwhelming amount of treasuries, the Federal Reserve ended up buying a big chunk of them, and so did the commercial banking system. And because there's so much treasuries issued to fund those deficits, the public couldn't buy them all. And so you had the Federal Reserve basically print money, buy treasuries. And because sovereign debt was so high, so federal government debt was over 100% of GDP, when you started to see inflation, they couldn't raise rates because it would render the US government insolvent, because when you have 100% debt to GDP and you're running 20% deficits, you can't have high interest rates on that. And so they just said, no, we're going to lock yields at 2.5% or less, and we're going to buy any treasury we need to in order to maintain that peg. So you had inflation going to the double digits, even as interest rates stayed at 2.5%. And so anyone holding cash or treasuries, you got all your money back nominally. No one defaulted on you if you were holding that safe paper, but you lost purchasing power compared to commodities. And so anyone holding treasuries over the course of that decade lost about a third of their purchasing power, even though they got paid their interest, they got their principal back, but they failed to keep up with purchasing power. So by the end of that decade, you could buy fewer goods, you could buy less house, less commodities with those treasuries, and that's historically what happens at the end of a long-term debt cycle. Is that you inflate a lot of that debt away, so that nominal GDP ends up kind of catching up to that debt, rather than that debt ever being paid back in real terms.
And so when it comes to China, back in 2013, they announced that it no longer makes sense for them to keep taking all of their dollar surpluses and reinvesting them in treasuries. Because the United States' system over time has been essentially that we're happy to run trade deficits with you, but take those dollars and go ahead and help us fund our deficits, right? So hold dollars and treasuries as your reserves. And so Saudi Arabia did that, Japan did that, Europe did that. They all went through these periods where they grew very rapidly. They were the big exporters, and they would hold it in dollars. And China went through that period as well. They amassed over $1 trillion in treasuries. And eventually they said, we have enough. It's not really in our interest to keep buying these things, especially, we saw the global financial crisis. These yields are poor compared to inflation. And so we're going to start doing other things. And then they announced the Belt and Road Initiative. So essentially what we've seen is that, China uses a lot of their dollars.
Sorry, just to jump in there very quickly. Is that why the Fed has had to start buying treasuries themselves?
I think it's part of it. We've seen a drop off in foreign demand led by China. Now, it's not, you see headlines like foreigners dump treasuries. They haven't dumped treasuries. They still hold more treasuries than they used to, but the percentage of total U.S. treasuries owned by the foreign sector has been shrinking because they've not been buying treasuries as rapidly as we've been issuing them.
Right.
And so generally any country, when they get over a certain debt amount as a percentage of GDP, the central bank becomes the major buyer of their government debt. And the United States is no different in this case because foreigners have dried up their purchases to some extent.
Right, okay.
And so with China, they've been more specific about it, where they said, okay, instead of buying treasuries, we're going to start using our dollars to make loans to different countries in the world, help build out infrastructure to help cement China's, hub, basically as a big trade partner along Eurasia and into Africa and, around pretty much the whole world, essentially. And also to secure commodities. So they'll invest in commodity projects around the world that they have rights to. And so they're essentially taking dollars and putting them into various types of hard assets, and basically doing kind of that, almost that type of financial colonialism that the United States and the United Kingdom have done in the past. They're doing a similar approach now. And so they're kind of rising to that superpower status, despite the fact that their GDP per capita is still kind of in that middle income trap.
Yeah, so if you go back to the Bretton Woods system, there are a bunch of economists that point out in the beginning that system would fail, just because of its own kind of instability. And so the way that system worked was that the United States dollar is backed by gold, and all other currencies in the world, or most of them, peg themselves to the dollar at a fixed exchange rate. The problem is that over time, the United States increased the amount of dollars in circulation. They increased their treasuries, but they didn't increase their gold reserves, and they actually drew down gold reserves as people redeemed their dollar for gold. And so by the time you got into the late 60s, you started to see a period where, gold was lower and dollar's liabilities were much higher. And the international community started to realize that, and they said, okay, we want to take the gold. And eventually, Nixon had to go up the gold standard because it would have just drained all the gold reserves. And so that system was just inherently unstable. Now, in the petrodollar system, we've kind of moved the instability to another area. And so the dollar is not backed by gold anymore, but instead it's kind of indirectly backed by oil.
For example, in the 1970s, there were various deals set up between the United States and Saudi Arabia and other OPEC nations to make it so that they only price their oil in dollars. So regardless of who buys it, if France buys it, if Japan buys it, whoever buys oil that has, basically has to import it from the Middle East and other countries, they have to do so in dollars, which means every country in the world that is not energy self-sufficient needs dollars. So they either can exchange their currency to get dollars, or they can start selling their goods and services in dollars as well. And so that's kind of an intentional design choice. And the way we were able to do that is because the United States has by far the largest navy in the world especially during that time and ever since. We're also at the time we're the biggest commodity importer and the biggest economy. We still are in some ways, but for example, China's catching up in some metrics and they've surpassed us in many commodity imports. But back then, it made sense in some ways.
China is, they're doing trade with Russia, and Europe's doing trade with Russia increasingly in euros rather than dollars. And so that's more currency diversification. And we're starting to see, for example, Saudi Arabia is still pricing their oil in dollars, but as we see maybe tensions between Saudi Arabia and the United States, as we see that now China is the biggest customer of Saudi Arabia, that situation could potentially change over time.
Right. So looking forward, it feels like the petrodollar is starting to fracture. I was reading this morning about Russia and India agreeing to trade oil in rubles, and there's been talk of China and Russia not trading within the dollar. What would the impact of this be if the petrodollar was to collapse? What would the impact be for the US?
Well, I mean, I think there'd be multiple issues. So one, there's two layers of it. There's medium exchange and store value. So if they start to do medium exchange outside of the dollar and the SWIFT system, right, then that reduces the United States' sanctionability and essentially hegemon status.
Well, so the Russia-India deal was in response to sanctions to certain Russians as well.
Yes, but one thing is so a lot of this has been building for a while. So, for example, there was a Bloomberg article back in 2019 that I highlighted in my 2020 petrodollar article that showed that Russia and India have been already going along that path. They basically agreed to increase their trade and to start pricing it outside of dollars. And so we actually already saw that building up ahead of time. And now, of course, there are certain catalysts like we're seeing today that can accelerate that. So it's not like it just went from 0 to 100 this month. This has been building and growing for a while, and it's already happening along the spectrum. And so Russia's kind of at the heart of the de-dollarization in the sense that, they're a large oil provider, so that impacts the petrodollar system. And they have massive trade with Europe, China, India, and other countries. And so because they've been aggressively de-dollarizing, the fact that these other peers go along with it, many of them either neutrally or that they also have an interest in doing it as well, like China, for example, they de-dollarize. Now, there's two layers of it. So one is the medium exchange, how they actually make the payments, because that can mean that the U.S. is unable to block them from trading. If they trade within a dollar-based system, the United States can block two countries from trading that have nothing to do with the United States. And so Russia, for example, has decided not to really hold treasuries anymore and to hold mostly euro-denominated assets as well as gold and some other types of assets. And people often think that a reserve currency has to be binary. Like you either have the reserve currency, you don't, whereas in reality it's somewhat of a spectrum. So the United States has, quote unquote, the reserve currency. It's very dominant. But the euro and the yuan are also these contenders where they're not really in a position to just replace the dollar and become the new kind of just by far dominant global currency. But really what they're aiming for is to be regional reserve currencies. They want to be able to trade with enough of their partners for key things they need in their currency. They've also been experimenting with, using, I don't know what blockchain it was, but they were using blockchains to basically do purchases of like iron from foreign producers of it. And so they've been experimenting with ways where they want to be as, so it's a couple steps. One is they stopped using treasuries as a store of value, or at least they stopped adding to their treasuries. They still have them, but they're not adding to them anymore. And then two, they want to find ways to have a medium of exchange that is outside of the SWIFT system. They don't want another country to be able to cut them off from buying commodities and trading with their partners. And so early phases of that included all sorts of testing. They have like a Singapore technology firm help them out, and they would do these technology experiments. And now, of course, the headlines are the CBDCs, where they basically can have programmable money, and they can trade with some of their trading partners outside of the SWIFT system. And so to the extent that that continues working with them, and they have a lot of clout because they're such a large trading partner with most of the world, right? So over the past 20 years, the United States used to be the biggest trading partner with most countries, and that's shifted more and more towards China, where the majority of countries, their individual biggest trading partner is China. And so the fact that they have all those pieces together gives them a pretty significant shot at being able to de-dollarize their payment systems. And we're seeing early signs of it. So a lot of it's centered around Russia, in the sense that Russia trades with Europe, China, and India, and some other countries now, either completely or partially outside a dollar-based system. That can include euros. So you can have an interesting thing where Russia and China trade using euros. You can also have their local currencies, like Russia and India. They can use their local currencies to do payments.
Do we know how much progress China's made with their CBDC?
It seems like a lot. They've been actively testing it because, lately we see in the past year or so, Western central banks are talking about, exploring it. Whereas China, from what I've seen, they've been testing it, researching it, I should say, as far back as 2014. Once Bitcoin was around for a while, and then once you had the emergence of initial stable coins, I think they woke up to that pretty quickly. And so they've been testing that for a long time. They've already actively tested their CBDC in many cities. It works in that sense. I think they're still trying to roll out all the details and make sure that the rollout process goes smoothly. But yeah, they're pretty far along on that. Instead of trading cash in a context where you might use physical cash, you would use this CBDC instead. And then also it can be useful for those international trading partners where they say, okay, if you want to buy our technology, they make a lot of equipment. They say, okay, you buy it with these CBDCs. So we'll buy commodities from you using the CBDC, and then you can use those to buy our technologies. And there's, depending on the country that they have clout with, if it's a very small nation and that they're very reliant on trade with China, China has a better probability of getting them to use that. Whereas maybe Russia says, we'll use a little bit of that, but we also want to use euros, or we also want to use rubles, for example, because they have some clout as well. So it really depends on the individual countries in question. Money is going to be increasingly digital, more so than already is. Right now, we think of it as digital. People joke and they're like, well, the dollar's already digital. It's like, well, it also runs on those very old pipes, for lack of a better word. There's this old legacy infrastructure, and then we interact with it in a digital way, but it still goes through these centralized pipes. And stable coins are quite different ways to transmit value. And so obviously money's going more digital, and it becomes, is it going to be more state and surveillance controlled, right? So almost like using Satoshi's invention against him, where this technology can enable CBDCs, it can enable essentially highly regulated private stable coins that might as well be CBDCs. For example, they can blacklist any addresses they want, they can block transactions. You have that approach, or you have Bitcoin, where it's kind of a defense against nations that are maybe being improper. And it's one of those things where if you're in a developed market, it can sound almost like you're an anarchist, for example. If you're you want to separate money from state, but it's not easy. It's not hard to envision it if you live in Russia, or you live in China, or you live in Nigeria, for example. Right? There's been cases that have been, I think, at this point well documented by the media, where, for example, Putin's opposition that is heavily repressed begins using Bitcoin. because they can keep their payment. They can get donations. They can send payments. You see it happening in Nigeria, where there's protest groups pop up. They're protesting police violence, and then their bank accounts get frozen, and they can resort to Bitcoin.
These places, it's like Latin America, West Africa, Southeast Asia, Eastern Europe. They're places that don't necessarily have the strongest respect for property rights. They might have a history of inflation. They might have a history of banking system that doesn't work or is used to plunder the savings of individuals. So it's all places where you have a reason to want to own your assets directly, outside of the control of either the state or the banking system. And it's not a coincidence that Ukraine was up there. Now, Ukrainians are relatively well positioned in terms of becoming refugees and asylum seekers and leaving their homes. Obviously, it's tragic that they have to do that, but leaving their homes with at least a portion of their savings intact because they can hold it on a hardware wallet or memorize 12 words. That's not really possible with gold, So that is a new thing. And people are going to be shocked in the coming months with the amount of stories that come out from Ukrainians saying, yeah, like the only reason I was able to secure anything, any of my financial security, any of my assets, anything like that, was because I had a digital bearer asset.
Well, those stories are already coming out. I've seen them.
Yeah, exactly. I mean, and like having a digital bearer asset, something you can truly own that's outside the banking system because it's not working in Russia or Ukraine right now. The ATMs aren't working. The currencies themselves are failing. The banks don't work. You don't have time to, get your, affairs in order or anything like that. Cryptocurrency, Bitcoin, is working, right? It continues to work. And now not everyone was onboarded onto it, obviously. Only a small percentage of the population was. But for those that were, it's a lifesaver. It's a godsend. And so it is this bottom-up movement that is demonstrating real value in, relatively developed countries. This isn't in like the total third world or anything like that. So I don't know how you ignore that case study. We see a lot of sort of like Americans dismissing cryptocurrency and Bitcoin, saying it has no use. But how can you possibly look at what's happening in Eastern Europe and think to yourself, this thing is useless now? Because it's the last line of defense financially for a lot of these people that would have had no alternative otherwise.
And while I live in a country where the rulers do a reasonable job of managing the money, most people aren't so lucky. So only 13% of humans in the world live in a country that's a liberal democracy with property rights and has what we call a reserve currency. You basically have the US, the UK, Australia, Switzerland, the euro, and Canada. I mean, those are like reserve currencies. And these are liberal democracies where people have reasonable guarantees over property rights. Everybody else either lives under like a weaker currency or an authoritarian regime. That's 87% of the world's population, almost 7 billion people. So for them, a sovereign savings account that's permissionless, meaning you don't have to have ID to use it, is a big, big deal. Close to 1.3 billion people who live under double or triple digit inflation. We're talking huge countries. Nigeria, 200 million people, 15% inflation. Turkey, 15% inflation for 100 million people. Argentina, 40% inflation for a country of 45 million people. So you can go down the list. There's about 35 countries where like people's earnings, their wages, are literally disappearing in front of their eyes over a matter of weeks or months against things like the dollar or gold or real estate, right? So this is a huge issue. It absolutely is a human rights issue for me. I mean, when it comes to your time and energy, having control over that or having it stolen from you, I think this is pretty clear. And Bitcoin is like an immediate, low cost, easily accessible solution for people.
Feels like there's an incentive for everyone to use it, but for different reasons.
Absolutely. I mean, basically going literally from cypherpunks to, unsavory types of either countries or individuals, or just people in Turkey that want to protect their purchasing power, or people in the United States that want to protect their purchasing power. Basically, there's one of the common problems worldwide is how to store your value, how to store your wealth, right? Especially in this era where we're essentially in financial oppression. So interest rates are below the inflation rate. Usually in terms of the official inflation rate, let alone whatever the quote unquote real inflation rate is, you're not really keeping up with the creation of currency. And so there's people are monetizing all sorts of things. They're monetizing art more than they used to. They're monetizing their homes. So you have home value to income ratios going up dramatically. You're monetizing stocks where you say, I don't even know what the stocks do. I just want to shove money into an index fund because it's better than cash. So we monetize all these other assets. And so the world pretty much has a store of value problem, and it becomes worse for emerging markets that don't have access to a lot of, you can't buy fine art, you can't, real estate is trickier, you can't buy the S&P 500. And so Bitcoin is one that they can all hold on their mobile phone. And then, of course, you have countries like Iran that say, okay, we want to be able to buy things if we want to, and there's this permissionless payment rail that we could use. So there's also pretty much any actor out there can use Bitcoin for a purpose.